Right, Robert, can we gauge the market sentiment about real estate? How confident everybody is, including our real estate chat viewers, about real estate, just by basing it on what kind of mortgages are being originated today?
Yes and no.
Well, we're going to find out on this episode of Real Estate Chat with
John Perez.
and Robert Eid. We're going to try to figure out what is everybody feeling about the market based on, let's say you bought a place today, what kind of mortgage you get. So, and what I mean by kind of mortgage, well, Robert shared this chart and basically shows the mortgage origination. So this was a couple, well, 2 weeks ago, but nonetheless, I'm sure the data hasn't changed by too much. And it goes through different rates of mortgages, variable, fixed less than a year, fixed 1 to less than 3 year term, fixed 3 to less than 5 year term, and fixed greater than 5 year term. And what do we notice here? Of course, aside from the neat little squiggly roller coasters of this graphic, variable rates took off when money was cheap for a very long time and then didn't become very cheap anymore. And where we're at now, I'm going to let Robert rip through this and give us an idea of what the market feels based on the kind of mortgages they're getting. Robert.
Okay, well, the thing that's missing, and we'll have to just fill in now, is let's look at this bottom sort of orangey line along the bottom, which is the very least favorite, orangey, which is less than a year. So we're going to say that's 6 months. And the rate for that is 7.49%. Okay, we're going to find the relationship between the percentage of use and the interest rate. Now, the next one, which is almost at the same place, is the variable rate, which is at, according to posted rates, it's 7.25. So it's almost the same. So that's its uptake is just about the same. Now, the next one is the gray, which indicates greater than 5 years. So greater than 5 years, let's say 7 years is 644 and 639. So that's if you want to lock in for 7 years and you want to pay 633, it's less than you would pay on a variable and less than you would pay on a 6 month, but it's expensive compared to where it was 5 years ago and expensive compared to the other one. So the next one up is the red one, which is 1 to less than 3 years. So let's call it 1 to 2. So 1 to 2, 1 year is 714 and 2 years is 699. Let's call it 7%. So 7% is being taken more often, but for a shorter period of time, 1 or 2 years, than the longer one, which is averaging out at 7 and change. Now, we go up to the top, the green one, which is 3 to less than 5 years. And the current rate for 3 is 654. And the current rate for 5 is 589. So those are the cheapest. So the most expensive have the least uptake, and the cheapest have the most. Is that unusual?
I don't think it is unusual. I mean, it makes sense that we're no longer in a variable rate environment. Who knows whether that will come back again in the near future? But I guess the biggest thing about this, Robert, is how long do our Real Estate Chat viewers who have subscribed and liked this episode, even though you dislike some of these rates, how long will they wait before, I guess, their next renewal? What's their current term at? What's their current amortization at? At what
Exactly.
point are they in their life?
Exactly. And
Lifestyle.
what's their comfort? How can they plan? Do they want to know what they're doing for 1 month at a time and guess that it's on the way down and it's going to take 2 years to go down? So will they be further ahead? And they're just interest averaging. If they pay 7 and change now, and at the end of 2 years, they're paying 4.75, are they better off going down the roller coaster than taking a steady state at somewhere in between? And that's the
Exactly.
whole
So there's the
arithmetic.
question for you. There's the question for you. Somebody on a variable right now who didn't see this coming, should they lock in? And there's several ways to answer that because, like, let's say, for example, you're in that situation, but you're not certain you're going to stay in your house for the next 2, 3, 4, 5 years. You would be paying penalties, right, Robert? If you went from variable to all of a sudden you locked in because you want to shave a little bit off of that interest. So the answer to that, I guess, becomes, do you see yourself moving? Do you see yourself living in the same place for when you do lock in? What happens if there is an opportunity? Are you prepared to pay for the penalties or whatever the costs are? Can you port your mortgage. And, by all means, we're real estate brokers. We're not we're not mortgage professionals. We can certainly recommend you to some professionals. But Robert, any final takeaways in terms of
Yes,
real estate?
the stress test. That the thing that's wrong right now, we know what interest rates are up and we know what why is, but the stress test, if you renew your mortgage with your existing mortgage company, you don't have to go through the stress test again, which is qualifying at 2% higher than what the face rate of the mortgage is. So there are some people who would like to switch, maybe because their lender is hard to deal with, did not do one of these extended amortization, which would have suited the person just dandy, but their lenders decided not to. But they can't leave that lender because they cannot qualify at another lender with the stress test in place. So you're quite right to point out, how long am I going to live here and do I want to pay? Because now at these interest rates and at these price or mortgage amount levels, it can be substantial. It can be $40,000. Now that's a substantial factor in whether or not you want to move or don't want to move. So yes, keeping flexible would be a reason to go short, and being unable to qualify at the plus 2% stress test would be a reason to stay where you are. So most people shop around a little bit. They see something online, they say it's, they're enticed by something they see that says a cheap, bargain, wonderful, and they find out there's something wrong with that. Go to somebody else and they talk to them at work. Who have you got your mortgage? Oh, XYZ bank is the best. And so they go and investigate over there, and they find out that they really only have two choices. One is bad and the other one's ugly. And they have to pick which one is less ugly, and then are really both of them available to them. Maybe only one of those is available to them because they can't leave their existing lender. So this is a toughie. That's a toughie we haven't seen before. There was always you have existing loan and we want interest to the balance of the term. We always had that. But this, you're up for renewal. Now you're not free. Now you're free to the extent that you can qualify for a loan in another institution because your existing institution has a leg up, a shortcut on how to keep you at without the stress test.
Well, there you have it. So informal survey for our Real Estate Chat viewers. If you're willing to share, let us know what you decided as far as your mortgage. If you bought something recently, where are you locking in at? Are you stuck with the variable? Or are you going in for that because you feel that this is not going to last much longer? Are you in a 1, 2, 3, 4, 5 year? Let us know in the comments, and we'd love to hear your comments and we'd love to hear your thoughts. Thanks for watching this episode of Real Estate Chat. Take care and bye for now.
To the reservoir. That's French.
Au revoir.